Hello guys, this is Shoaib Yaqub. Welcome to the P4 webinar. We will cover all main topics of P4. The benefit of getting this webinar is that we are going to discuss the key technical areas which will guide you to put most of your efforts in the right direction. We will ensure that by the end of this session, you will be able to meet the examiner expectation, the P4 examiner. It is a complete revision package to ensure that you will get passed in your final exam of P4. Let's have a look at the paper pattern. Obviously, P4 paper has two main sections. Section A, which includes the 50 marks case study. In section B, there will be 3 questions in exam, 25 marks each, out of which you have to do 2 questions, obviously 25 marks each, which will cover the 100 marks paper. The main and key topics of the P4 are investment appraisal, which includes the most important topic, APV. Then international investment appraisal, when you invest in some foreign projects. Then merger and acquisition, corporate restructuring, forex, the foreign currency risk management, interest rate risk management, and option pricing theory. These are the main topics in which 4 questions will be set, one of 50 marks question and 3 questions of 25 marks each. And 50 marks question can be set from any of these key topics. You can guess from the past paper, but actually in every examiner report, our examiner always state that don't try to predict me. So it is very obvious you cannot predict the 50 marks question. Examiner has a full choice to give this question from any key topics of the P4. What are the common reasons for unsuccessful attempt in P4? First one, not enough practice questions. Obviously, if you do not practice well and you do not have a good preparation, you have a very few chances to get successful in exam. Then next reason is poor time allocation in the exam. You have 3 hours to complete the paper, but if you poorly allocate your time to 1 or 2 questions instead of the whole 3 questions, obviously you can't pass the exam. Not attempting all parts of a given question. Let's say if a question has 4 parts, A, B, C and D, every part of each question is very important. So if you do not attempt all parts, you don't have full chance to get passed in the exam. Not answering the question as expected by the examiner. If examiner has asked something else and you are answering something else, obviously that will not be enough to get successful marks in exam. Not enough knowledge about the subject area. You have prepared only few areas, not all the areas, so it will be difficult for you to get through the exam. Panic in exam is a very important reason to have a failure in exam. If you get panicked to see something unseen, in that panic situation, you do not complete all the paper. It will be very difficult for you to get passed. Whenever there is something unseen in exam, do not panic. Just take an assumption. Obviously, we will discuss in next few days how to tackle the exam. But in this very first webinar video, I'm telling you, just take an assumption and try to solve all the part of the question. Like for example, if there is a question of NPV, obviously it's a very common and familiar topic. if there's a question of NPV in exam, and first part is to calculate WACC, and second part to calculate NPV, and you're not sure that you have calculated exactly the right answer of WACC in A part, but you know how to do the NPV question, then take assumptions of WACC. Let's say you have taken an assumption that WACC is of 10%. Just try to solve the B part. You will get full marks of the right steps of part A, but in part B you will get full marks because you have taken an assumption. Only 1 mark will be deducted for that assumption, but rest of the marks will be allotted to you. But if you get panic in exam that you don't know the very basic part of WACC in part A, and you left that question, obviously you will lose it's near to 15 to 20 marks. So instead of losing 15 to 20 marks, just take an assumption and try to solve the question. If you do not know, or if you are not satisfied with the part A question, take the assumption of that part and solve the B part. You will get the full marks of B part, only you will lose the part A marks, but at least you can pass. If you leave all the question, then it is very difficult for you to pass in the exam. So what are the common examiner expectation from the P4 students? Obviously, first one is thorough knowledge of the subject is required in exam. Do not panic in exam. Keep your confidence level high. Assume that you are the one who will pass if you complete the exam. Be confident. Always try to read theoretical answers of past paper. Try to build the theoretical vocabulary from the past paper. Try to build the theoretical expression from the past paper. And try to read the answers. Try to write the answers. It will definitely improve your writing expression, which helps in scoring good marks. Candidates should attempt complete paper. It is very necessary. And should try to answer all part of the question, because if you have completed 100 marks question, obviously you will be required 50% marks to pass in the exam. But if you have only done the 80% 80% question in exam, then it will not you required 50% to get pass. Obviously you need 60 to 70% marks to get pass in an exam. Good time management is required, which can only be achieved by attempting past paper under time constraints. Especially in last week, try to write one past paper under the 3-hour time constraint. Well presented and well structured answer often get high marks. This doesn't mean that you will lose some marks on your handwriting, but well presented and well structured answer means you have a professional approach, and obviously professional approach will get the best marks. Good answer provided a balanced answer for all part of the question. Let's suppose if there are 4 parts in exam and you know well one of the part, and you try to write extra material in that part and you are not writing enough material for rest of the parts, that is not a good approach. For a better approach, try to develop a balanced answer for all part of each question. Do not forget to attempt the complete paper. Candidates are not able to answer according to what is being asked in the requirement. This can be if the candidate does not read the requirement carefully. So try to read the requirement carefully. Do not misinterpret it and try to understand it. If you do not understand, try to read the question again. If you do not understand the question in first instance, try to read that question again. Definitely in second and third time reading, you will understand the question. It will obviously it will consume your time, but at least you can understand fully what is being asked from the examiner. So in this webinar, we will be covering all the main topics, all the key areas of the P4. In today's session, we will start from the APV, then International Investment Appraisal, and in the same sequence, we will cover all the webinar videos. So let's start from the very first topic, APV, Adjusted Present Value. Before studying Adjusted Present Value, let's have a look at its background. Let's suppose just try to understand this. Business risk, let's suppose there is a question and exam of investment appraisal, and after reading the question you have realized that the project which is being introduced in that question has the same business risk and it is being financed with the same existing gearing. So after reading the question, if you have realized that the new project has the same business risk and it has the same financial risk, then you will discount all the data of that new project with the existing WACC. If the business risk is same and if the financial risk is also same, then you are going to discount all the data of that project with the existing WACC. Let's suppose after reading the question, you have realized that the new project is different from the existing business, means the new project has different business risk, but it is being financed with the same financial risk. It is being financed with the same existing gearing. Let's say if previous gearing is 40% and 1 million is required in the new project, that means you are going to finance 0.4 million from the debt and 0.6 million from the equity. So if business risk is different but the financial risk is same, then you are going to discount all the data of that project from the risk adjusted WACC. Risk adjusted WACC is a very basic topic of P4, and even it is a topic belong to F9. And what about if after reading the question you have realized that business can be same, business can be different, but you have realized that the new project is being financed with totally different gearing level. The new project is being financed with a different financial risk. The new project is being financed with entirely different capital structure. The one which company has, the new project is being financed with totally different capital structure. If capital structure is different, if financial risk is different, either business risk is changing or it does not. If financial risk is changing, you are going to appraise that project using APV, Adjusted Present Value. Whether business risk changes or it doesn't. But if financial risk changes, you are going to appraise that project using the method APV, Adjusted Present Value. So let's have a discussion on the APV method. In APV method, we are going to divide the whole project cash flows in two sides. First one is investment side and second one is financing side. First one is investment side and second one is financing side. We will cover first one, the investment side in one, then we will cover the financing side. Okay, there is some protocol today. We are going to cover the topic first, then I will give you some time for the question answer session. So if you have any question, please ask in the question answer session. We will cover topic first, then we will have a discussion on your question answers. Okay, in APV, we will divide all the data in two sides. First one is investment side and second one is financing side. Remember, when we are going to use the APV, when there is a different financial risk, either business risk is changing or not, but if financial risk is changing, if financial risk is different, we are going to appraise the project using adjusted present value. And in adjusted present value, there are two sides. First one is investment side and second one is financing side. So what about investment side? In investment side, all the performer is same, like in investment appraisal, the same performer as in investment appraisal. And what about that performer? If you remember, that performer starts from years 0, the start of first year, 1 and 2, revenue, variable cost, relevant fixed cost, operating cash flows, tax savings on capital allowance, working capital changes, investment, and scrap value. Then we have a total, the net cash flows, and then we discount that net cash flows with a suitable discount factor. So performer is same as an investment appraisal, starting from revenue till the net cash flows. But in order to discount it, we have to use ungeared cost of equity. Why we are using ungeared cost of equity? Because we are assuming that we will exclude all the financial risk. We will take all the financial risk from the investment side, and we will be putting that financial risk in the financing side. We will cover all the financial risk in the financing side. So in investment side, we are just assuming the specific risk of the project, the investment, the risk of investment cash flows only in the investment side. We have excluded all the financial risk or financing risk from the investment side, and it will be covered in financing side. So in investment side, you cannot use WACC as a discount rate, but because WACC includes the financial risk. So as we exclude the debt and equity from the WACC, we will be left with cost of equity. And in cost of equity, we know that there is financial risk in beta. If we remove that financial risk from the beta, then we will be having only beta asset. As we know that cost of equity is equal to risk-free rate plus beta equity, return on market minus risk-free rate. And beta equity includes business risk, financial risk. In APV, we are assuming that we will exclude all the risk, all the financial risk from the investment side, and the financial risk will be covered in the financing side. So if we remove this financial risk from this cost of equity, this cost of equity will become the ungeared cost of equity. This cost of equity will become the ungeared cost of equity, or the cost of equity with the beta asset, because if we remove financial risk from the beta equity, then the beta will become the beta asset. So we are assuming that we will exclude this financial risk. So the beta will become the beta asset, and the cost of equity will become ungeared cost of equity. So in investment side, same performance as an investment appraisal, but you will have to use ungeared cost of equity as a discount factor. How you gonna calculate ungeared cost of equity using asset beta? Just try to learn from the question that nature of business is same or it changes. If nature of business changes, then there will be a proxy company. Try to ungear the equity beta of the proxy company, because we know from the basics, because there will always be a beta that is beta equity. If in exam there is a beta asset given, examiner will specifically mention that it is a beta asset. But anytime whenever beta is given, that will be a beta equity. So if nature of business changes, you have to ungear the equity beta of the proxy company. When you ungear the equity beta of the proxy company, that will become the asset beta. So let's say you have after reading the question, you have realized that nature of new project remains same. Nature of the project is not changing. Then you have to ungear the equity beta of your own company. If nature of business changes, then you are going to ungear the equity beta of the proxy company. If nature of the business remains same, then you are going to ungear your own equity beta. Whichever the case, just remember you have to ungear the beta equity and you have to calculate the beta asset. Then putting that beta asset into the CAPM equation, that is equal to risk-free rate plus asset beta into RM minus RF, and you have a ungeared cost of equity. Okay, if there is no beta given and cost of equity is given, so you have to check that nature of business is same. No, nature of business is not same. Then you are going to ungear the cost of equity of proxy company. If nature of business is same, then you have to ungear your own cost of equity. So the last equation is the theory, Modigliani and Miller theory with text version. That is equal to cost of equity geared company is equal to cost of equity ungeared plus 1 minus T, cost of equity ungeared minus KD, debt over equity. So in exam, equation is given like this. Cost of equity of geared company is equal to, it will be given in exam, cost of equity of ungeared company plus 1 minus T it will be given, and you are going to calculate this. Obviously, if nature of business is changing, then cost of equity of geared company will be given of proxy company. Text will be given of proxy company. KD will be given of proxy company. Even debt of equity is given for the proxy company. So by putting the debt equity of proxy, KD of proxy, text of proxy, and geared cost of equity of proxy company, and just by arranging the data in this equation, you are going to calculate the cost of equity of ungeared company. So this equation will lead us to get the answer of ungeared cost of equity. So in exam, if beta is given, then ungear that beta and use the CAPM equation to get ungeared cost of equity. And if in exam, if cost of equity is given of the proxy or even your own cost of equity, using this theory equation, you are going to calculate the ungeared cost of equity. So that's how you're going to calculate ungeared cost of equity, and using that ungeared cost of equity, discount all the relevant cash flows of the investment appraisal, and the answer of investment side will be, base case NPV. The answer of investment side will be base case NPV. So what about financing side? We are going to cover all the financing effect in the financing side. The first one is issuance cost, present value of tax saving on interest, subsidized loan, and debt capacity. So let's have a look at the financing side. We are going to learn all the elements of financing side with the help of examples. So the first example is, a company is considering a project that would cost $100,000 and it will be financed 60% by equity, 40% by debt, and the cost of debt is 4%. Tax is at 30%, issuance cost of equity is 4%, and issuance cost of debt is of 2%. We know from the basic that issuance cost of equity is normally higher than the issuance cost of debt, and that is being raised for 5 years. So what will be the first effect? First step will be, you have to calculate the funds required, and it is quite obvious in this example that funds required is $100,000. Funds required is $100,000. Then you are going to split that funds required into debt or equity. What are the different proportions required to debt or equity? 60% funds are required from the equity, 40% funds are required from the debt. So $60,000 is being required from the equity, $40,000 is being required from the debt. Okay, let's suppose 60,000 funds are required through equity and you have raised $60,000. And if you raise $60,000, obviously 4% of that $60,000 will be the issuance cost, and it will be near to $2,400. And out of $60,000, $2,400 will go to the issuance cost, and you will be left with $57,600. Obviously, you will be short of funds to support the machinery and other initial requirements. So we will assume that these funds are 96%, as issuance cost is 4%. So we will assume that these funds are 96%. We will gross up these funds, and we are assuming that we will raise enough funds that will be sufficient for issuance cost as well as for the initial cost. So I have taken an assumption that we are going to raise gross up funds, which is, I have taken its gross up value of 96%, 62,500. The issuance cost is 2,500, because out of 62,500, 2,500 are for the issuance cost, and the remaining 60,000 is for the initial cost. For the debt, we will take the same assumption, as issuance cost is of 2%. So we will assume that these funds are 98%, and we have taken its gross up value, that is 40,816. So the issuance cost is 816. Okay, we have raised funds 40,816 and the issuance cost is 816. Normally, debt issuance cost is an allowable expense. Normally, debt issuance cost is an allowable expense. So if the issuance cost is an allowable expense, you can claim saving. Let's suppose tax rate is 30%, which is given. You can claim saving on this 816 that will be equal to 245. So after netting off net, it's not saving, it's net issuance cost. So the net issuance cost is equal to 571. Net issuance cost was 816, but tax saving is 30% of this value, that is of 245, and the net issuance cost is equal to 571. Okay. Then this was the very first adjustment. Equity issuance cost, debt issuance cost. And the next one is present value of tax savings on interest payment. As we know that we have taken a loan and we are going to pay interest every year, and if we pay interest every year, we are going to save 30% of their interest every year. And if a loan has a duration of 5 years and we are saving 30% of interest every year, then take the present value of all the tax savings on interest, that will be your tax shield, that will be your present value of total savings. So gross loan into interest rate into tax rate. We have raised 40,816. Interest rate is 4%. Tax rate is 30%. So every year the tax saving is 480. If tax saving is 480, that it will be like this. For 1 to 5 year, tax saving is 480. So we are going to discount this 480 for 5 years definite time period using the annuity factor. What are the different discount factors available for the financing side? There are 2 discount factors available for financing side. You can discount it with before tax KD or before tax risk-free rate. You can use any of the discount rates. You can either use KD, either use risk-free rate. There is no compulsion. There is no specific guideline for it. Examiner has used risk-free rate in different questions. Even examiner has used KD in different questions. Whenever examiner used KD, it has always been stated in exam that full credit will be given to those candidates who have used the risk-free rates and the vice versa. So I have used 4% KD as a discount rate, as an annuity factor for 5 years, that is equal to 4.452, and we multiply tax saving, annual tax saving with the 4.452, and that is equal to 2,137. Equity issuance cost is a negative figure. Net issuance cost is a negative figure, but present value of tax shield is a positive figure. Okay, now we are going to cover the effect of subsidized debt. If you have any question till the previous slide, you can ask, then we will cover the next part of example. Okay, there are few questions. First one is, should we use post-tax rate for the annuity factor? No, you can't use post-tax rate as annuity factor. You are going to use the before tax rate for annuity factor, because in financing side you are going to discount the tax saving effect, and if you take the after tax discount rate, that means you are going to duplicate the working. So always use before tax discount rate as annuity factor. If beta asset is given, don't we have to regear it first? No, you do not have to regear it, because in investment side always use please listen carefully, in investment side always use ungeared beta, all equity finance beta, the beta asset. Okay, can you please repeat the concept of choosing beta asset or equity? Remember one thing, always use beta asset in investment side. If beta equity is given, then ungear it and use beta asset. If cost of equity is given, then ungear it using equation and use ungeared cost of equity. Nature of business mean, let's say if in previously you are in electronics business and now you are moving to the hotel business or tourism business, that means your nature of business is changing. What are the assumptions for using KD and risk-free rate as discount factor? Actually, there is no assumption. Examiner has given an open choice to use KD or risk-free rate. But as a concept, you can say you can use risk-free rate whenever there is a subsidized debt, because when government is an investor in your business, then your capital structure has a very smaller level of risk, very reduced level of risk. So you can use risk-free rate. But examiner has asked to use KD or risk-free rate, but you just have to state assumption in exam. When we will gross up, I mean what is stated in exam, there is a question. Normally question is silent. There is no information in exam. So always take an assumption that you are going to gross up the debt and equity required in exam, unless the examiner stated in exam that there is enough funds available for the issuance cost. Normally, there is no question in past paper in which examiner has stated that funds are available for the issuance cost. So always take the assumption, always gross up, always take the gross up value. And remember one thing, you can take different assumption from the examiner, but examiner will give you full marks if you state that assumption in exam. Okay, there's a question, but if we are given after tax cost of an exam, remember one thing, when there is a statement in exam that KD is 4%, that means KD is before tax. That means KD is equal to YTM, yield till maturity. KD is equal to GRY, gross redemption yield. Yes, if there is a statement that after tax KD is 4%, that means KD is after tax. Otherwise, whenever there is a statement that KD is 4%, KD is 5%, that means KD is before tax. Okay, let's start from the example again. Then we will again come back for the question answer session. Okay, we have covered till the last slide. There's a minor correction here. It is equal to 490. Smaller mistake here. It's equal to 490. So obviously it will carry to the answers. So let's move to the next example. Here it is. A company is considering a project that would cost $100,000 and it will be financed 60% by subsidized debt, the cheaper debt which is normally being offered from the government, and it has an interest cost of 4%, and 40% by the normal debt. 40% by the normal debt, which has a cost of 7%. So subsidized debt has a cost of 4% and normal debt has a cost of 7%. Tax is 30%. Normal loan issuance cost of debt is 2%. Normal loan issuance cost of debt is 2%. Debt is raised for 5 years. It is assumed in this example only that there is no issuance cost on the subsidized debt. It is only for the simplicity purpose. Otherwise, normally there can be issuance cost on the subsidized debt. Risk rate is 5%. So the very first step is calculate funds required. So funds required is equal to 100,000. In exam, normally funds are required for the initial cost. Like funds are normally required for the plant and machinery, land, building, or working capital. So in this example, funds are required $100,000. Subsidized debt required is $60,000, as we know from this question. Normal debt is required for $40,000. Okay. Subsidized debt raise is equal to $60,000 because there is no issuance cost on it. Normal debt raised, we are going to take the gross up assumptions. So normal debt required is 40,816. Issuance cost is 816. Tax saving is 245. An exam, and normally in past paper question, examiner do not calculate tax saving on issuance cost. So there is no problem if you have calculated it. Obviously, examiner will not deduct the marks. And net saving is equal to 571. Okay. Now the next step is calculate tax shield. Now we have two type of loan: the normal loan, the subsidized loan. And in both type of loan, we are paying interest. So if we are paying interest on both type of loan, that means we will save tax on both type of interest rates. So in normal loan amount is 40,816 and we are paying 7% interest on it, and we will be saving 30% interest, 30% tax on it. So 40,816 is the loan amount, 7% is the interest rate, 30% is the tax rate. So every year for 5 years, we are saving $857 on interest. Okay, in this example, I have taken the assumptions that we are going to discount the financing side with the risk-free rate, but you have a total freedom to take the assumption that you can discount it with the normal KD, the normal discounted, that is 7%, but before KD, before tax KD. So at 5% discount is 4.329. So by multiplying these two figures, the answer is 3710. That is present value. of tax shield. It is present value of tax shield. In subsidized debt, funds required in subsidized debt was $60,000, and there is an interest cost of 4% on it. Tax rate is 30%. So the tax saving on interest payment is equal to $720. As annuity factor is 4.3 to 9, so answer will be 3,117. So that is present value of tax shield on subsidized debt. So that is the first working of the subsidized debt. That is, even if you have a subsidized debt, you are paying some interest on it, so you can save some tax on it, and you are saving $720 every year, and by taking its present value, that is equal to 3,117. So the next part is, instead of 7%, you are taking loan at 4%. If you don't get the subsidized debt, you must have taken the normal debt that was at 7%. But now, instead of paying 7%, you are just paying 4%. So the first step is, you are saving interest every year. You are saving 3% interest every year. So take its present value. That is the second adjustment of the subsidized debt. 60,000 is a loan amount. 3% is an annual saving on it. So you are saving $1,800 every year. By taking its present value at the annuity factor 4.3 to 9, you have calculated present value of interest saving, that is equal to 7,792. But if you have paid that interest, you must have saved tax on it. Now you are not paying 3% interest, so that means you are not saving tax on it. So the next concept is, you are going to lose tax on that interest saving every year. So you have to calculate present value of tax loss on interest saving. That is equal to $60,000 into 3% into 30%, that is equal to 540. And by discounting it with the annuity factor 4.3 to 9, the present value of tax loss is equal to 2,338. Obviously, you can do it in the single step, and that was the third step, but you can do these two steps in a single step, and that is 60,000 into 3%, that is the annual saving of interest. You are not paying 3% interest, so that means you are not saving tax on it. So take its after tax value, that is equal to 1,260, discounted with the annuity factor, obviously the same annuity factor which we have decided above, 4.3 to 9, that is equal to 5,455, the present value of after tax interest saving shield. Why there are two methods to solve these two steps? In exam, remember the rule, if in exam same year tax payment rule is given, then you are going to use this single step to solve the present value of after tax interest saving. If in an exam same year tax payment rule is given, then you are going to use this single step to solve the present value of after tax interest saving. And if tax is being payable in 1 year in arrears, in that case, you are going to solve present value of interest savings separately and present value of tax loss separately, because you are going to save interest saving of year 1 in year 1, interest saving of year 2 in year 2. That means if company is paying, if company is saving year 1 interest, if company is saving interest annually from year 1 to 5, that means this single step will be exactly same. You are going to save interest from year 1 to 5. But if you are saving interest from year 1 to 5, but tax is being payable in arrears, that means you are going to lose tax of year 1 and year 2. You are going to lose in tax on interest of year 2 and year 3, of year 3 and year 4, year and 4 and 5, and you are going to lose tax of the interest of year 5 in year 6. So in order to calculate present value of interest saving, you are going to use the same annuity factor. But in order to calculate the tax loss on interest saving, you have to calculate the delayed annuity factor. And what about that? 5-year annuity factor, multiply it with the 1-year discount factor. Whenever there is a statement in exam that tax is being payable 1 year in arrears, remember one rule, that use the same annuity factor but discount it with the discount factor of year 1, because whenever cash flow starts after year 1, when let's say cash flows are being started at year 2, when you apply the same annuity factor, its answer will be at the end of year 1. Like if we assume that you are going to have interest on every year, a tax will be 1 year in arrears. So when you use 5-year annuity factor, these 5 years will be starting from year 2 till year 6. So its answer will be at the end of year 1. So always remember, whenever tax is in arrears, do multiply with the same annuity factor, but then multiply it with the discount factor of year 1. Because whenever cash flow starts from year 2 and you apply annuity factor, its answer will be at the end of year 1. And if answer is at the end of year 1, multiply that answer with the year 1 discount factor. So even in the previous slide, even in the case of tax shield, if tax is given 1 year in arrears, just multiply the annuity factor with the discount factor of year 1. Discount factor of year 1. You are going to do this adjustment only if tax is being payable in 1 year in arrears. If tax is being paid in the same year, then obviously you can use the normal annuity factor. But if tax is payable in 1 year in arrears, you are going to use the 1 year delayed annuity factor. And that is quite simple. That is, use the 5-year annuity factor because loan is of a 5 year, but do multiply it with the year 1 discount factor. Okay, the last concept is debt capacity. Debt finances a project because of the associated tax shield. If a project brings about an increase in the borrowing capacity of the firm, it will increase the potential tax shield available. Let's suppose if in an exam there is an example that debt capacity has risen to $120,000. That means because of the new project you can raise new funds of at least $120,000. And you have checked that you have already borrowed $100,000. That means there is an unutilized capacity of $20,000. And you are already familiar with the MM theory, Modigliani and Miller theory. That is, take the maximum amount of loan, because on every new borrowing you will get tax saving on interest payment. So you take an assumption, that is, it is assumed that this remaining capacity, the $20,000, will be utilized elsewhere in other projects. So you are going to take assumption that you will use this unutilized capacity in a shape of borrowing in some other projects. And if you are getting saving in other projects because of this project, obviously you are going to cover that saving in this project. And that is 20,000 unutilized capacity multiplied with the normal interest rate, because you can't take an assumption that even in case of debt capacity, subsidized loan will be available. So in utilized capacity, you always take the normal interest rate, multiplied with the normal interest rate, then multiplied with the tax rate. So in this example, annually you are getting 420 as a tax saving. Apply the annuity factor over it. So present value of tax shield due to debt capacity. Let's suppose if there is a statement in exam that the debt capacity is exactly the same which you have borrowed. Debt capacity is exactly the same amount which you have borrowed. That means there is no unutilized debt capacity, and you are not going to do this calculation in exam. So if you have any question till this slide, you can write in the chat box. Let's have a discussion on the questions. Okay, there's a question. FKD is given in a form of LIBOR plus 2%. Does that mean post-tax? No, it's a pre-tax rate. LIBOR plus 2% means it's a pre-tax rate. And another question is, will there be a tax saving on the unutilized debt capacity? Yes, I have covered it now. There is a tax saving on the unutilized debt capacity. You have to calculate it. Just remember one thing. If there is a debt capacity level given in exam, just compare it with the amount of loan you have borrowed. Let's suppose, like in our previous example, if total debt capacity is $120,000 and you have borrowed only $100,000, that means unutilized capacity is $20,000. So you have to take tax saving on interest payment on that unutilized capacity. Why we take tax shield on the unutilized debt but we don't use it? It's not the assumption. We are going to use that unutilized capacity. Like I have written the statement here. It is assumed that this remaining capacity will be utilized elsewhere in other projects. You can't take assumption that you are not going to use. It's a very foolish way that you are not using the debt capacity, but you are claiming it's saving. It's not that way. You have to take assumption that this remaining capacity will be utilized elsewhere in other projects. Obviously, if you have taken this assumption, then you are going to cover its tax saving. Okay, there's another question. We have to use the present value of tax shield in APV calculation while taking assumption. Yes. If you guys don't have this slide, it will be provided. Don't worry. Okay, there is another question. Will the extra capacity will be included as a cost of investment in NPV calculation? No. The extra capacity is not a cost. Extra capacity is because your overall risk of the project has been reduced because the new project is in that type of area which will reduce the business risk. So as business risk is lower, you can afford to increase the financial risk, or there can be some another reason like because of the new project availability of non-current asset has been increased, and because of that there is an increase in the net capacity. If there is no debt value mentioned but mentioned ratio, then you can take the ratio of the funds required. Like funds required is $100,000 and you are going to raise 60% from the debt. That means you are going to raise $60,000 from debt. Okay, these were the questions. Let's have a look. Now we are going to cover some past paper question. There is a question given in your handout. Okay, in your handout section, question number 2 is given. Just have a look at this question. Just have a look at this question and we will cover in few minutes. Try to read this question. We will discuss this question in 10 minutes. Welcome back. Yeah, let's go through the requirement. Evaluate on financial grounds whether Fubuki company should proceed with the project. The question is very general, like examiner has asked that evaluate on financial grounds whether company should proceed with the project or not. That means you have to evaluate whether this project is profitable, feasible or not. That means you can solve it even with the NPV or with APV. Question is silent. There is no specific requirement that you should solve it with the APV. You have to decide by using your knowledge and the scenario information that you are going to use the APV method. But let's say if you are stuck in the exam and you don't know anything and you can't remember the basic requirement of APV, just remember one thing. If there is issuance cost, if there is subsidized debt, that means that question is for APV, not for NPV. Okay, let's have a look at the question. The Fubuki is a company name. That company is going to start a new project and its selling price is $4,000 minus 37.5% discount. So that means the selling price is 4,000 minus 37.5% discount. That means selling price, the new selling price is equal to $2,500. So the selling price is $2,500. This is a completely new venture. That means business risk is being changing from the previous business risk of this company. Okay, the company can take subsidized debt of up to 80% of the investment fund required. So the subsidized debt is 80% of the funds required at a rate of 200 basis points below the Fubuki company borrowing rate. And the company current borrowing rate is 300 basis points above the 5-year government debt yield rate. And that is the risk-free rate. So the normal borrowing requirement is, the normal borrowing rate is risk-free rate plus 3%. And the subsidized rate is risk-free rate 200 basis points below risk-free rate plus the 1%. Obviously, the project is of 4 years and company can sell it for 16 million at the end of 4th year for 16 million. Okay, the feasibility study commissioned by the directors at a cost of $250,000, that will be a sunk cost. Initial cost of acquiring premises is equal to 11 million. And the machinery cost is equal to 3 million, and this process is a very quick immediate process. That means these both costs will be incurred in year 0. So the initial cost required is 14 million. That means you have to finance this 14 million from the funding. Obviously the funding of debt and the other. It is expected that in the first year, units are 1300. Units will be grow by 40% in each of the next 2 years. That means 1300 into 1.4 in the year 2. Then the answer multiply with the 1.4 in the next year before falling to annual growth rate of 5%, and in year 4 the growth rate is only of 5%. After the first year, 2500 selling price in year 1. After the first year, the selling price per year is expected to increase by 3% per year. So that means after every year, selling price will be increasing by 3% per annum. Okay, that means like units will be year 1, 2, 3 and 4. Units will be 1300 in year 1. In year 2 it will be 1.4, and that will be equal to 1820. In year 2 it will be again by 40%, and that will be equal to 2548. And in last year there will be a growth of only 5%, and that will be equal to 2675, and the price will be in year 1 it will be 2500, and every year it will increase with the growth of 3%. Growth of 3% means in next year it will be like this, and in the remaining 2 years it will be raised to power 2 and raised to power 3. How are you going to calculate the price? Okay, in the first year it is estimated that direct material, labor and variable overhead cost is 1200, and every year it will increase with 8%. Annual fixed overhead cost is 2.5 million, of which 40% is relevant because 60% belongs to centrally allocated overheads. That means 40% is relevant. Fixed overhead cost will increase, and those 40% will increase every year by 5% inflation rate. Fubuki company will need to make working capital available of 15% of the anticipated sales revenue for the year at the beginning of each year. The working capital is expected to be released at the end of the 4th year when the project is sold. So once you have calculated the sales, let's suppose you have calculated the sales. Let's suppose this is year 1, 2, 3 and 4, and this is year 0, and you have calculated the sales. So the working capital requirement is 15% of sales. Take 15% of this, then take 15% of this value, 15% of this here value, and then after doing this, calculate working capital change. Let's suppose I am taking an assumption that it is equal to 200, 250, 300, 350. In first year, obviously it's a first time investment, it's 200, you can completely take 200, and next year it will be 50, next year it will be 50, Even in the next year, it will be 50. And in the last year, all working capital which you have invested will be recovered. You are going to take these values into the pro forma. I have just taken the assumed figures. Okay, let's move to the question again. Company tax rate is 25% on the taxable profit. Tax is payable in the same year when the profits are earned. Tax allowable depreciation is available on a straight line basis. It is anticipated that value attributable to the plant and machinery after 4 years 400,000. So the initial cost was 3 million. Initial cost was 3 million. So the depreciation will be 3 million minus 0.4 million over 4. So the every year depreciation is equal to 650. And the tax saving will be 162.5. Company uses 8% as its discount rate for the new project, but feels that this rate may not be appropriate for this new type of investment. Obviously, the feeling was true because financial risk is changing and company is going to use the APV. It intends to raise the full amount of funds through debt finance. If you raise full amount of funds through debt finance, that means your gearing is going to be changed. And to take the full advantage of the subsidized loan, issues cost is 4% of the gross finance. You have to gross up the funds. It can be assumed that debt capacity available to the company is equivalent to the actual amount of debt finance raised. That means there will be no unutilized capacity. Although no other companies produce the same mobility vehicle, there is another company, ACCA, which has a cost of equity. Cost of equity is given, beta is not given. This company is paying 28% tax. Company has a 15 million shares trading at 2.53 and 40 million bonds trading at 94.88 per $100. And currently the government debt rate is, risk-free rate is 4.5, premium rate is 4%. So how are you gonna calculate the ungeared cost of equity? We are going to calculate ungeared cost of equity using this equation. Remember this, 1 minus 0.28. So this is 14%. This is what we are going to calculate. This will be 0.72. This is the X factor. KD is not given. Proxy KD is not given. So we are assuming that its KD is equal to the risk-free rate, that is 4.5%. Okay, what about debt? Okay, debt is equal to 40 million trading at 94.88. So if we multiply 40 million with 94.88 divided by 100, how are we gonna cover it? 40 million divided by 100 into 94.88, and that is equal to 37.95. And 15 million shares with market value per share is 2.53. It is almost equal to 37.95. This is again 37.95, and just by rotating this equation and solving the X factor, that's how we're gonna calculate the ungeared cost of equity. Okay, let's move to its answer. Okay, this is the base case NPV. First one is sales revenue, direct cost, fixed cost is of 40%. That are the profits. Working capital change, that is of 15% of sales. Initial cost of 14 million. Scrap value is 16 million. Net cash flows, and how we have calculated the cost of equity here. How we calculate the cost of equity. Value of equity is 37.95, value of debt 37.95. By putting the 14% here, 4.5 here, how we have calculated 10%. Discounted all the cash flows at 10%, we have a base case NPV equal to 708. Okay, examiner has given the note that discount rate can be estimated by calculating the asset beta and then using that to estimate the cost of equity. Okay, in year 0, funds required is equal to 14,488. If funds required is 14,488 and all of the funds are required from the debt finance. So how we gonna solve the financing side? Let's solve it here. So funds required are, fund raised are 14,488 over 96% into 100%. That is equal to 15,092. Normal debt is of 20%. Subsidized debt is of 80%. So 20% is equal to 3018 and 80% is equal to 12074. And obviously issuance cost is equal to 15,092 minus 14,488 is it will be equal to 604. You can calculate tax saving on it. Okay, then the next step is calculate tax shield. And tax shield will be 3018 for normal debt into risk-free rate plus 3%, 4.5 plus 3%, that is equal to 7.5% into 25%, and discounted with the NVD factor. You can discount it with the risk-free rate. So let's suppose discounted is as risk-free rate is 4.5%, so take its NVD factor value, and that will be equal to 3.59. So discounted it with 3.59. So that is a tax shield of normal loan. That is a tax shield of normal loan. So it will be equal to 203. And what about the subsidized debt? 12,000 0.74. Subsidized debt cost is 2% below the normal rate, that is equal to 5.5% into 25%. Discounted at 3.59. Just for simplification, I am doing it in the single step. That is equal to 12074 into 0.055 into 0.25 into 3.59. That is equal to 596. That is tax shield. This is tax shield of normal loan. This is tax shield of subsidized debt. And what about the after tax interest saving? After tax interest saving. I'm solving it here. After tax interest saving. And that is equal to subsidized debt into annual saving is 2% into take its after tax value, that is 0.75 because tax is payable in the same year, so you can solve it in the single step, into 3.59, and it will be equal to will be equal to 650. That is after tax interest saving of subsidized debt. Okay, examiner have given some notes, and that is examiner has not included the gross up value here. Examiner has calculated all the working using 14,488, but we have calculated all the working using 15,092. But note is given, full credit will be given if the issue costs are included in the funds borrowed. So that's not the problem. If you stated the assumption, you will get the full marks. Okay, in calculating the present value of the tax shield and subsidy benefit, annuity factor used is based on 4.5%. We have taken the same assumption, but it could be argued that 7.5% may also be used, as this reflects the normal borrowing default risk of the company. That will be given where this assumption is made to estimate the annuity factor. Okay, you can discount even with the 7.5 or even with the 4.5, but remember, you just have to take the before tax value, that is 4.5 or 7.5. So by adding all these values, 203, 596, 650, and deducting the issuance cost plus the base case NPV, you can calculate by taking the total of these, by taking the sum of all these values, you can calculate the APV. That's how you're going to calculate the APV. APV question can be correct if you have different assumptions from the examiner, because examiner will always give marks on the valid different assumptions. So if you have any question from the Fubuki part, you can write in the chat box. Okay, there is a question, can we use different discount rates for each element of the financing side? For example, KD for tax shield and receipt rate for other? No. Normally, you are going to use one assumption at a same time. For example, if you have assumed that you are going to use risk-free rate, then it means you are going to use risk-free rate for all the data of financing side. And if you have used KD as a discount rate, that means you have assumed that KD shows the normal debt capacity, normal risk level of the business. That means you are going to discount all the data using the cost of debt. Okay, there is another question. How would we draft the assumption for including issuance cost? Remember one thing, just assume in the exam that you have gross up the value and the initial cost plus issuance cost is being financed from the long-term funding. So just state in the exam that you are going to finance all the issuance, all the initial cost plus the issuance cost using the long-term funding. How you estimate? There is another question. How you estimate HESM cost of equity is geared? Remember one thing: the beta and the cost of equity will always be geared. If there is an information in exam that the beta or cost of equity is ungeared, examiner will specifically mention that this cost is ungeared. Okay, there is another question. Yes, you have to mention that whether you have included the issuance cost in the initial cost, whether you are going to use the gross up value or you are going to use the net value. If you state that assumption, obviously there is a full chance that you will get the full marks. So you always remember one thing: in exam, the paper is a way of communication with the examiner. If you communicate all the matter related to the question using that paper with the examiner will give you maximum marks. But if you do not communicate, if you communicate in a very unprofessional way, examiner will not give you the full marks. Okay, now I'm moving to the next area. Now I'm moving to the next area, that is international investment appraisal. Okay, this is very important area. Often there is a 50 marks question from international investment appraisal, but it can be 25 marks question from this area. There are 4 adjustments from this area. By having a grip on these assumptions, you can easily solve all the questions of the international investment appraisal. So the first one is forecasting exchange rate. That is the very first assumption. Forecasting exchange rate, because in international investment appraisal you are going to invest in some foreign projects, and let's suppose you have invested for 5 years project, and during that 5 years, every year that foreign project will pay you some remittance, and every year you have to convert the foreign remittance into your currency, and so you need every year exchange rate to convert the foreign remittance into your home currency. So how you gonna calculate future spot rates? You can calculate using the purchasing power parity formula, that is equal to current spot rate into 1 plus inflation of first currency divided by 1 plus inflation of second currency. What I mean by first and second currency? Let's learn it with the help of an example. Spot rate is 1.7050 dollar over pound. The currency which is in numerator, its inflation should be put in the numerator. Like in this example, inflation of USA, inflation of dollar is 5%, so I have to multiply it using this. And the currency which is in denominator, its inflation will also be in denominator, like 2%. It will be equal to 1 plus 2%, that is 1.02. And by solving it, its answer will be 1.7551. In order to forecast second year future spot rate, I will take the answer of first year spot rate as a base, then multiply it with the inflation of next year and divide it with the inflation of second currency of the next year. I can solve the future spot rate of the next year. So this is the future spot rate of year 2. And by taking it as a base for the year 3 calculation, I will multiply with the inflation rate of USA, the first currency, and divide it with the inflation rate of UK, 1 plus inflation rate of UK, that is of the second currency. You can solve it the third year future spot rate. So using purchasing power parity formula, that is current spot rate into 1 plus inflation of first currency divided by the 1 plus inflation rate of second currency, I can calculate the future spot rates. These future spot rates are necessary because using these future spot rates, I can convert the future remittance of foreign project to convert these remittance into our home currency. Okay, next adjustment is impact of taxation. It's very simple. That is the second adjustment. What is it? In this, there is a very simple rule. If you have paid higher tax in foreign projects in foreign country, if you have paid higher tax in foreign project in foreign country, you do not have to need to pay any tax in your country. So if you have paid, let's suppose your country tax rate is 30% and you have already paid 40% in foreign country, you do not have to pay any new tax in your home currency. Let's suppose there is a tax rate of 30% in your country and in foreign project you have only paid 20%. So that means you have paid lower tax in foreign country. So you have to pay additional 10% tax in your home country. Like let's learn it with the help of an example. Double taxation relief will be given. You have to pay only extra tax. Let's suppose project is carried out in the USA. So foreign subsidiary is US and the parent company is in UK. So if you have already paid 40% tax in USA, so you do not have to need to pay any tax in UK. Scenario 1, no further UK tax. If you have already paid 33% tax in USA and there is the same tax rate in your country, you do not have to pay further tax. And if you have paid 25% tax in the foreign country and in your country tax rate is 33%, that means you have to pay extra 8% tax. And remember one thing, you are going to pay that extra 8% tax on the gross earned amount, on the gross USA earnings, not on the earnings distributed by the USA company. You are going to pay 8% tax on the gross earnings. So that's how you're going to calculate the tax impact. Now we will cover the intercompany cash flows. If you have any question till now, you can write in the chat box. Okay, there's a question. Kindly explain gross company cash flows for the excess tax rate. We will cover in next example. Okay, that's all. Let's start with a new concept, and we will cover the tax concept again in this example. Intercompany cash flows such as transfer prices, royalties, management charges can also affect the tax computation. Intercompany transaction, like parent company will sell some goods to the subsidiary company at higher prices, or subsidiary company can pay some amount to the parent company in a shape of royalties, or parent company can charge management charges to the subsidiary company. From these areas, parent company can collect some extra amount from the subsidiary company. Let's suppose parent company will say subsidiary has to pay some royalty amount because parent company has given some license or some other thing precious to the subsidiary company. So subsidiary company will pay royalty every year to the parent company. That royalty will become expense in the subsidiary company, but that royalty, which is an expense of the subsidiary company, it will be income of the parent company. So parent company will have to pay full amount of tax on that royalty amount which has been deducted as an expense in the subsidiary company. Okay, let's learn this concept with the help of an example. A project carried out by a USA subsidiary. A project carried out by a USA subsidiary of a UK company is due to earn a revenue of 100 million in the USA. Remember one thing, our subsidiary is in US and we are in the UK. Subsidiary in USA and we are in the UK. So subsidiary is earning $100 million. It's a year 2 working with the associated cost of 30 million. So cost is in 30 million. Royalty payment of $10 million will be made by the USA subsidiary to the UK. That means subsidiary is paying $10 million in the shape of a royalty to the UK company. That 10 million will be an expense in the subsidiary cash flows, but that 10 million will be an income in the parent company cash flows, and parent company will have to pay full amount of tax on that income because subsidiary has not deducted any tax on that income. That is the concept here. Assume tax rate is paid in the USA 25% and in the UK 33%. Assume a spot rate is $1.50 over pound. So let's learn the answer with this computation. Revenue is 100 million, cost is 30 million. So royalty is 10 million. So the pre-tax profit is equal to 60 million. And USA company is paying 25% tax on it. That is equal to 15 million. 60 minus 15, 45 million is being remitted to the parent company. Okay. When we remit 45 million, that 45 million will be converted at the exchange rate of $1.50 over pound. That will become equal to 30 million pound because all the workings now will be in pounds. And royalty 10 million is being transferred from the subsidiary company to the parent company. It will also be converted at $1.50 over pound. It will now equal to 6.7 million royalty. Now, there is a two income flow to the parent company. One is 30 million and the other is 6.7 million. This 30 million is the remittance, and subsidiary has deducted 25% profit on it. So you just have to pay extra 8% tax on it. But do not calculate tax, do not charge tax on this 30 million. Go back and check with what are the gross earning. This was the gross earning of the subsidiary, 60 million. Convert that 60 million at 1.5 into pounds, 40 million pound, and apply 8% on the 40 million pound. That tax will be equal to 3.2 million pound. So subsidiary has remitted 30 million pound to the parent company. The parent company have to pay 8% tax on it. But remember one thing, do not calculate tax on the remittance. Go back to the working of subsidiary, check what are the gross earning, that was 60 million, apply 8% tax on that 60 million, but after converting it into pound. Okay, now the next earning is 6.7 million pound in the shape of royalty. Subsidiary has not deducted any tax on it. So you have to pay 33% the complete tax rate on the 6.7 million, that is equal to 2.2. And by taking the total of these two taxes, total tax will be 5.4 million. The after tax cash amount is 31.3 million. What is the catch here? If subsidiary has deducted royalty or management charges, deduct complete expense in the subsidiary cash flows. But you have to take these cash flows as income in parent company cash flows, and you have to pay full amount of tax on these cash flows. If parent company has sold some units to the subsidiary company, that will become the cost in the subsidiary company cash flows, but parent company have to pay full amount of tax on the income earned on those units sold. So in case of intercompany cash flows, any expense which is being transferred from the subsidiary to the parent company, any income, royalty, management charges or contribution, any income which is being transferred from the subsidiary to the parent company will have to pay full amount of tax on it, because subsidiary has not deducted any tax on it. Okay, let's move to the next example, remittance restriction. Normally in developing or emerging countries, governments sometimes put restrictions on the remittance. Normally the emerging governments or the developing governments block the remittance or put restriction on the remittance transfer. It can be a partial blockage or it can be a full blockage for a number of years. For example, we have a subsidiary in USA, and this subsidiary has earned 3 million, 4 million and 6 million in these 3 years. Let's suppose this is an example, and government has blocked our funds for 4 years, and government has allowed to transfer the funds at the end of year 4. So what you gonna do there? You are not going to transfer funds every year, because funds are only allowed to transfer at the end of year 4. So you are going to reinvest these funds, year 1 funds, for 3 years for year 4. You are going to reinvest year 2 cash flows for 2 years, and you are going to reinvest year 3 cash flow for 1 year to year 4. And once you got the permission to transfer the funds, you can collectively, combinedly transfer all the years cash flows at the end of year 4 to the parent company. So what about in this project? In any 1 year, only 50% cash flow generated can be remitted back to the parent. In this particular example, you are allowed to transfer 50% of the cash flows to the parent company, and remaining cash flows will be there with the subsidiary company. So you will transfer 50%, and it's a very basic example. In this example, cash flows are not being reinvested, but normally in exam you will be given a question in which you have to reinvest the cash flows, year 1 cash flows for 3 years, year 2 cash flows for 2 years, year 3 cash flow for 1 year, and those reinvested cash flows will be remitted back to the parent company at the end of year 4. What is the problem here? Problem is that parent company will not receive cash flows in first 3 years, and parent company will receive cash flows at the end of year 4. So as higher time value of money discount factor will be applied. So normally if there is a block remittance restriction, your NPV will be lowered compared to the scenario where remittance is not restricted. So how are you going to tackle it? So that's how you're going to tackle it. Now this is the final performer. This is first side. It will start from the years, that then foreign currency. First step is put the sale receipts, sales year, then deduct variable cost, wages, incremental fixed cost, and tax royalty. You can deduct royalty, management charges, or the inventory cost which you have bought from the parent company. Then deduct the tax allowable depreciation. Deduct the tax allowable depreciation, the capital allowances. Taxable profit, apply the foreign tax, add back tax allowable depreciation because you have deducted tax allowable depreciation from the above cash flows. Cash flows will be lower and you have to pay lower tax every year. And then add back the tax allowable depreciation because it's a non-cash expense. Then why you have deducted at the first instance? Because when you have deducted the tax allowable depreciation from the above cash flows will be lowered and you have to pay lower tax. You have automatically calculated tax saving on it. Initial outlay, then at the end year realizable value, then take the working capital change, then take its total, that will be equal to net foreign cash flows. Then all the net foreign cash flows will be converted into the home currency using the exchange rate that will be based on purchasing power parity theory. Convert all the foreign cash flows at the exchange rate into the home currency. That is the remittance. Apply additional tax on it. Let's suppose you have paid 20% foreign tax. Now your on tax is 30%. You are going to apply additional tax 10%, but do not apply tax on the remittance. You will go back. This was the gross earning. Apply the additional tax on it. We'll apply the additional tax on it. Okay. If your country tax is higher than the foreign tax, you have to calculate the additional tax. Do not apply that additional tax on the home currency remittance. Apply that additional tax on the gross earnings of subsidiary. Okay, then you royalty or management charges or contribution on the inventory will be claimed as income. You have to pay full tax on it, then take the net value and apply discount rate on it. That's how you're going to calculate NPV of international investment appraisal. So have a look at this performer. After this, we are going to solve the past paper exam question. If you have any question, please write in the chat box. Okay, there are few questions like explain the concept of adding back tax allowable depreciation in the performer. It's very simple. Deduct depreciation from the above cash flows. Your profit will be reduced and you will have to pay lower amount of tax on it. And when you have to pay lower amount of tax on it, that means you have automatically covered tax savings on the capital allowances. But do add that capital allowances from after the tax calculation, because capital allowances are non-cash expense. Then if capital allowances are non-cash, then why we have deducted it? We have deducted it just to reduce our profits and just to reduce our tax calculation. Okay, the another question is tax rate of home currency will be applied on taxable profits after the conversion into home currency? No. Look, if you have converted into the home currency, you are going to pay only additional tax. And that additional tax will be applied on the gross earnings of the subsidiary. Okay, there's another question. What if you have to reinvest in case of block remittance? Okay, let's have a look. Okay, let's have a look at this slide. I'm assuming that your funds are blocked. Your funds are blocked for next 4 years. You can only transfer the funds at the end of year 4. And in the subsidiary country, you can reinvest the funds at 5%. So what you are going to do, you will reinvest this 3 million at 5% for the next 3 years, because you are at year 1 and 1, 2 and 3, and after year 3, at the end of year 4, you are allowed to pay amount to the parent company. So how are you gonna do it? You will reinvest 3 million at 5% for 3 years, and it will be equal to 3.48 million, and year 4 will be reinvested at 5% for at 5% for 2 years, and it will be equal to 4.41. And this 6 million will be reinvested for 1 year, and that will be equal to 6.3 million. So the total will be 14.19 will be remitted back to the parent company, and this will be with the reinvested amounts. So remember one thing, if you have a situation of block remittance in a question of P4, normally you have to reinvest those blocked funds in the subsidiary country till the permission is granted to transfer the funds to the parent company. Okay. Yes, if there is another question. If 50% funds is blocked, then you are going to reinvest only the 50%. Okay. There is another question. The reinvestment of block remittance will be on the company cost of equity. The question is, the reinvestment of the block remittance will be on the company cost of equity. If that happened, that will be the ideal case, because your government has blocked the funds that is supposed to be transferred to the parent company, but you have some avenues available to reinvest the block remittance at the cost of equity. That will be the ideal situation. But if the cost of equity is not available, but if let's suppose there is no suitable cost of equity avenue is available, then you are going to reinvest at least at the available rates. But if let's suppose some avenue is available to reinvest the funds at cost of equity, that will be the perfect scenario. If there is no reinvestment rate mentioned, then what to do? There is another question. If there is no reinvestment rate mentioned, what to do? You just assumed and write in the notes that these funds should have been reinvested. You will be awarded with the number. Examiner will award you some marks. What about the block reinvestment funds? Will they be remitted later? Yes. The block fund will be ultimately remitted later. Okay, these are all the questions of the from the block remittance. If question is silent, no reinvestment rate is given, just write in assumptions that these funds should have been reinvested in the block remittance time period. Do not show calculation, but at least write some explanation that you know that these funds should have been reinvested. Do not show calculation, but at least explain it. You will get the marks. Remember one thing, if you got stuck in the calculation, just explain it. You will get marks on the explanation. Okay, there are a couple of questions that at which rate we are going to reinvest. If there is no rate given for the reinvestment, just explain it. You do not have to show all the calculation. Just explain it that you know that these funds should have been reinvested. But if examiner wants the reinvestment calculation, examiner will provide you some reinvestment rates. At least examiner will provide you the basic interest rate of that country. So don't worry about it. In worst case scenario, just explain this situation that block funds should be reinvested at the interest rates of subsidiary country, because funds are being blocked in the subsidiary country, so it should be reinvested into the subsidiary country interest rates or given rates. Okay, let's have a look at the questions. There is a question in your handout section. That is Yelendeep. The question from your handout section, I think it is of June 2015 attempt. Let's have a look at this question. We are going to cover in 5 minutes. Okay, let's have a discussion uh, on this question. What are the requirements here? Requirement first, discuss the possible benefits and drawbacks to the Imonico of setting up its own assembly plant in Yelendeep compared to licensing a company based in Yelendeep to undertake the assembly on its behalf. So there is a comparison between pros and cons of setting up its own plant, that is direct investment, and the licensing. It's a very simple question of 5 marks. Then prepare a report which evaluates the financial acceptability of the investment in the assembly plant in Yelendeep. 21 marks are for the calculation. Discuss the assumptions made in producing the estimates and the other risks and issues which a mining company should consider before making the final decisions. So 17 marks are allotted for the assumptions and the other risk and issues. 17 marks. Provide a reasoned recommendation on whether or not company should invest in the assembly plant in Yelendeep. And 3 marks are being allotted for the reasoned recommendation. Professional marks will be awarded in part B for the format, structure, and presentation of the report. So let's have a look at the question. Question is, Yelendeep, whose currency is YR, has faced extremely difficult economic challenges in the past 25 years because of some questionable economic policies and political decisions made by its previous governments. Population is generally poor. Its people are well educated, ambitious. Just over 3 years ago, new government took office. It has imposed a number of strict monetary and fiscal controls. And copper tax is 40%. Its copper tax is 40%, and it has attempted to bring its inflation down from 65% to 33%. Okay, the government is popular in the larger cities, but less popular in the rural areas. So inflation in year 1 is 22%, 14.7, 9.8% onwards. The government decided to continue the progress made so far by encouraging foreign direct investment into the country. Recently, government representatives held trade shows internationally and offered businesses a number of concessions, including zero copper tax payable in the first 2 years of operation. That means you do not have to pay any tax in the first 2 years of operations. And the second one is an opportunity to carry forward tax losses and write them off against the future profit made after the first 2 years. So if you have any loss in the first 2 years, you can carry forward those losses to the next available profits after year 2. Government representative also promised international companies investing in Yelendeep Government representative also promised international companies investing in Yelendeep prime location in towns and cities. So there is a risk of government, risk of political risk. If government changes, these benefits can be withdrawn from the new government. Monaco, a large listed company based in USA with the US dollar as its currency, manufacture high-tech diagnostic component. After attending one of the trade show, company has decided to invest in your plant. So they will setting an assembling plant there. Once assembled, the component will be exported to the Euro. to the European Union, which will be priced in euros. So, okay, let's have a quick view. It is initially assumed that project will last for 4 years. So it's a 4-year project. 4-year project will require investment of 21,000 million for land and building, 18,000 million for machinery, 9,600 million for working capital. Working capital will increase every year at the start of each next year with the relative inflation, and it will be released back at the end of 4th year. It can be assumed the assembly plant can be built very quickly and production started immediately in year 0. This is because the basic facility infrastructure are already in place, as the plant will be built on the premises and the ground of school. The school is ideally located near the main highway and the railway lines. There is an ethical issue because you are going to set up your assembly plant on the location of school. So the rights of children will be heard and children will have to relocate it to another school. The government has kindly agreed to provide a free buses to take the children to these schools for a period of 6 months, only 6 months instead of 4 years. The selling price of the component is €700. Price is likely to increase by the European Union inflation rate from year 1 onwards. Not after year 1, from year 1 onwards. Number of units are given: 150, 480, 730 and 360. These are in thousand amounts. The parts needed to assemble into the components in Yelandi will be sent from the USA by Imani company at a cost of $200, from which company will currently earning $40 as a contribution. However, Imani company feels that it can negotiate with the Yelandi government and increase the transfer price to $280. That means on this component, parent company will earn $40 plus the price hike $80. That means companies on this component, company is going to earn, the parent company is going to earn contribution of $120. So parent company will sell the special component to the subsidiary and parent company will earn $120 on each component every year. And obviously this is before considering the inflation. Okay, the variable cost has a value of 15,960. Current annual fixed cost of assembling plant is 4,600 million. All these costs, wherever incurred, are expected to increase by that country's annual inflation every year from year 1 onwards. So every cost will increase from year 1 onwards with the annual inflation of their respective country. Imani company pays copper tax at a rate of 20% in the US. That means subsidiary company will charge 40%, parent company will charge 20%, so there will be no additional tax. Tax in both US and Yelandi is payable at the same year. Bilateral tax treaty is existed. Tax allowable depreciation is 25% every year on the machinery on a straight line basis. Imani company will expect annual royalty from the subsidiary every year, that is $20 million, but company feels that it can negotiate with the government and increase the royalty fee by 80%. And obviously we will take assumption that this royalty will be increased by 80%, that will be equal to 36 million, because even if government is currently giving the tax concession, giving it school for the assembly plant, this government can easily be agreed on these terms of increasing the royalty amount. If company does decide to invest in the assembly plant in Yelandi, it export from the USA to the European Union will fall, and it will have to redundant its previous workforce, and it will have to face the redundancy cost of, that is after tax cash flows, just 20,000, 55,000, 57,000, 59,000. No 000 is being rounded off, so it's a very small amount, very immaterial amount. Company normally uses its cost of capital 9% to assess new project, but the finance director suggests that project specific discount rate is 12%, which is more relevant. euro per dollar rate is given, YR per euro is given, YR per dollar is given, YR per dollar forecasted rates has been given, YR per euro forecasted rates has been given, and the expected inflation rates of next 2 years for the euro and next 2 years and the year 3 onwards, and the expected inflation rate of USA is given. Why inflation rate of USA is given? Because certain components are in dollar. Why inflation rate of euro is given? Because sales is in euros. So let's move to its answer. So the first one is benefits of investment as opposed to licensing and drawbacks of investment as opposed to licensing. What are the benefits of direct investment? Company may be able to benefit from setting up its own plant as opposed to licensing in a number of ways. So what are the number of ways? L&D want to attract foreign investment and is willing to offer a number of financial concessions. So financial concessions are only available to direct investment. The company may be able to control the quality of components more easily because you are yourself controlling the plant, and offer better and targeted training facilities. The company may also be able to maintain confidentiality, and investing internationally may provide opportunities for risk diversification. Finally, direct investment may provide a mining company with new opportunities in the future. And what are the drawbacks? Direct investment in a new plant will probably require higher and upfront cost. A mining company will most likely be exposed to higher risk involved with the international investment, such as political risk, cultural and legal. And a mining company, on the other hand, will need to become familiar with the local system, so it will take time consuming. Okay, and the last one is similar. Investing directly in L&D may mean that it costs mining company more to train the staff and possibly require a steeper learning curve from them. Okay, but the scenario does say that country has a motivated and well-educated labor, so this issue may be mitigated. So what about the numerical part? Okay, the first working is of sales. Selling price is given. Obviously, the selling price was 700. It is being increased. It has been increased with the inflation of euro. And we know from the question that inflation of euro was 5% for the first 2 years. Then it was 4% from year 3 onwards. So this 700 has been calculated as 700 into 1.05, 735. Then 735 into 1.05. And from year 3 onwards, growth has been reduced to 4%. So the answer of year 2, 772 into 1.04. Then answer of year 3 into 1.04. That's how you have calculated the selling price. Okay, this is the price of parts. Remember, the part special component price was 280, and it has been inflated with the inflation rate of dollar. And inflation rate of dollar was 3%. So this 280 has been increased every year with a 3% inflation. Then variable cost has been increased with the inflation rate of YR, which is different in every year. Like if we go back to the question, it was 22% in year 1, 14.7% in year 2, 9.8% in year 3. So variable cost has been increased every year with the different inflation rates of YR, and its final answer is this. So sales revenue 150 are the number of units into selling price into exchange rate, because sales is in euros and you have to convert euros into the YR. So sales in YR is 150 is the number of units, 735 is the selling price, 165 is the rate YR over euros. So every year exchange rate is different, and every year sales is equal to 18,191, 66,775. These all amounts are in millions. Then part cost, 150 is the number of units of first year, 288 is the part price per unit, 120.1 is the exchange rate of YR against the dollars. Variable cost is simple, you have just multiply the variable cost per unit with the number of units. That's how you're going to calculate the variable cost. Okay, this is the main performer. You have calculated the sales, you have calculated the parts and variable cost. Fixed cost was simple. Fixed cost is simply inflated with the inflation rate of YR. Then you have calculated royalty fee. Remember, the royalty fee was 20 million that you negotiated with the government. It has been increased by 80%. So now royalty fee is $36 million. Now convert this $36 million every year with the exchange rate into the YR. And these exchange rates are 120, 133.7, 142, 151.9 for year 1 to year 4. Examiner has just explained its working. He has not calculated, he has not shown the calculations. It is possible, because if you show every calculation, obviously there is very there is very less time is available in exam, so you can explain the workings instead of showing all the relevant calculations. So, and then you have deducted the tax allowable depreciation. So the next amount is, in year 1 there is a loss, in year 2 it's a profit, year 3 profit, year 4 profit. You will not charge any tax in the first 2 years, and you have a leverage to carry forward the first year loss against the year 3 profits, because in question it has been stated that you can carry forward the losses against the profits. So you cannot claim this loss against the year 2 profit, because in year 1 and year 2 there is no tax. So we have carry forward this loss against the year 3 profit. So year 3 profit will be reduced and you have to pay lower tax. Add back the depreciation against cash flow after tax is given. Cash flow after tax is being calculated here. Working capital change is very simple. Working capital of 9600 is given. Just inflate the working capital with the inflation of YR, yield and leave, and then take its difference, then take its change. Current pending amount is 39 million. Then all amounts are in YR. Then using the exchange rate, these exchange rates were given. Convert these YR amount into the dollar amount, that is 479.16, 179. Now these amounts are all in 000 format. Okay, now remember, you have sold some parts to the subsidiary company at $120 contribution. So now That $120 contribution will be your income. Inflate that $120, multiply it with the number of units. That's how you're gonna calculate your income here. $120 per unit is your income. Inflate it with the dollar inflation and multiply it with the number of units. It will be like this: units into $120 contribution into 1 plus inflation of every year. Like in year 1, number of units are 150. This will be 120, and in year 1 inflation is 1.03, and that will be equal to 18,540. Then again royalty is same every year, that is 36 million. In 000 it will be 36,000. Okay, this contribution royalty is your income. You have not paid any tax in the subsidiary country, so you will have to pay full amount of tax, 20% on the sum of these two values. Then take the total of these all amounts and discount it with the project specific discount rate of 12%, and the present value are these value, and the take total and then take the total of these values, that is equal to 140 million, and it's positive, and you should accept the project. Why we have not covered, why we have not deducted the redundancy cost? Because redundancy cost was very immaterial, that is equal to nearly equal to 0.1 million. Obviously 0.1 million, 0.1 million can be ignored if the answer is 148 million. And that is the discussion part for 17 marks, assumptions made and other risk and issues. It's a very simple question. You can get maximum marks in these type of question just by taking assumptions and explaining all the risk. If you have any question from this question which we have just covered, you can type in the chat box. Okay, there is a question how we get the $120 contribution. When we are selling that special component to the subsidiary company at $200, we were already earning $40. And when we have increased its price from $200 to $280, that straight $80 price rise is the increase in contribution. So that $80 plus the previous $40 is the increase in contribution. Okay, there is another question. There was no tax for first 2 years. Shouldn't we pay tax for the first 2 years in the US, then ignoring the loss in first year? Yes. Look, if you read the theoretical part of the answer, we have taken an assumption that if we are not paying any tax in Yelendeep, we are also not paying any tax in the US country. But you can take assumption that if tax is exempted in Yelendeep, but we have to pay tax in the US, you will get the full marks. Okay, there is another question. If redundancy is material, will it be accumulated? Will it be calculated in parent company portion? Yes, definitely it will be calculated. Okay, there is another question, sir. Some working can we do in the main performer? It will save time. Yes, it can save time, but I will not recommend to do working in the performer. I will rather say you can save time just by explaining the working. Like if you are short with the time, you can just show the sales working. Like you can show the sales working like this. Sales is equal to number of units into selling price into 1 plus inflation into exchange rate. That will be enough because you have explained, you have write all the detailed formula that how you have calculated the sales. You do not have to show the working of for the 4 years. You have shown the formula that how you're gonna calculate the sales working. That's how you're gonna show the formula of sales, variable cost, and other just to prove that you know how to calculate these final figures. So it will save you plenty of time. There is another question, how I have calculated the royalty. Royalty is being calculated like here. Royalty was $20 million. It was increased by 80% to $36 million. And then I have multiplied it with the exchange rate of YR per dollar, because royalty is in dollars, but I have to deducted it in the YR performer, LND performer, so I have to converted it into the YR. So 36 million into exchange rate, that's how I have converted the royalty into YR. Okay, there is another question from where we will deduct redundancy cost if it is material. So I'm assuming that redundancy cost is material, and let's go back to the performer. If redundancy cost were material, then you must have deducted it into the calculation of parent company cash flows. Into parent company cash flows. You must have deducted here. Obviously, there is no enough space here, but you must have deducted parent company redundancy cost from the parent company cash flows, and after its reduction, then you have calculated the cash flows, and then you will take its present value. Okay, so, there is another question. Any suggestion for preparing theory effectively? Yes. For theory, in B4, there is almost 40% part of discussion. What you're gonna do, try to read answers of P4 questions. Question means past papers. Then try to write those answers into your wordings. By rewriting 3 to 4 past papers, you will have a grip on theory, and that is the bet. You will have a grip on theory if you just rewrite at least 3 to 4 past papers. And rewriting past paper means you have to rewrite all the questions of the past papers. Okay, there is another question. Past paper answers are enough to study or kit answers? Obviously, past paper answers. Will you provide us a list of questions that we must do before exam? Yes, I'm just give me some time. I will give you the list of questions. There is another question. If redundancy cost is to be deducted, does it need to be discounted? If redundancy cost is to be deducted, obviously it has been deducted in the net cash flows, and you just have to discount only the net cash flows. Okay. Try to solve these questions. I don't exactly remember the attempt, but you can Google it. I think it's Burang PLC. For APV, that is enough. And for the international investment appraisal, you can solve FTO or Tramont. It's a very good question. And if you have time, try to read chapter 4A and B of BPP, and that is of multinational. That is of multinationals. This is a very boring chapter, but if you read that chapter, if you read that chapter, obviously you have a very bright chances to write the theory in a correct way, because whenever there is a question and exam from the international investment appraisal, examiner always asks some theory, some theoretical point from that chapter of the multinational. So try to read that chapter and try to solve these 3 questions. If you solved these 3 questions and if you read this chapter, that means you have covered today's topic of basic investment appraisal and the international investment appraisal. Okay, that's all from today. If you have any query, you can email me at it's Ymail, not Gmail. If you have any query, email me. I will answer your queries. Best of luck, and we will meet tomorrow. Thank you so much.